here's what we see when I look at what happened in the, and there's no detrending here. We see that output in the United States declines by 35% in 4 years. A lot of that's associated with drops in productivity, but also a lot in hours worked. Capital output ratio, of course, goes up because capital stock tends to move pretty slowly. I don't have a utilization measure in here. Some of the papers we put utilization in, it doesn't always do much for the story. Because it doesn't work the right way coming out of the problem. But we see something very bad is going on. Now, to sort this out, what we do is we want a model. So I'm going to use the simplest kind of general equilibrium model. And it's going to have the responses of firms and households modeled based on how they behave in more tranquil times in terms of investment, working, consumption, and so forth, to see how they react to changes in productivity and government policy. Now, here's the problem with this analysis. I've never written a, you're saying this is real business cycle theory. I've never written a paper in real business cycle theory, and I'm kind of skeptical about a bunch of it. So this is an assumption I don't like at all. Movement and productivity is exogenous. I think the holy grail in this line of research is to try to model productivity. In particular, model how productivity reacts to things like financial crises and government policy. I'm not successfully there yet, though. Okay, but then, taking as a caveat that we're doing this thing that we don't like, which is modeling productivity as exogenous, I can compare what happens with what happened in the data, what happens in the model with what happens in the data. So here's my picture again. I put productivity in as exogenous. Something that's interesting to notice about this, and I think this is the major contribution that Cole and Ohanian made here, was pointing out productivity might have caused the downturn, but if the economy had followed the path of productivity, we would have been out of the Great Depression much faster than we were. Productivity recovered rapidly. When we look at the output series induced by putting that into my general equilibrium model, I'll be a little bit more specific about what the model looks like when I get to the next exercise. We see that the model does a fairly good job, not completely, but it does a fairly good job of capturing the downturn, completely misses the recovery. Capital labor ratio is about right. The reason it's off is because output's off. What really we miss is hours worked. There's something really wrong with labor markets in the United States in the late 1930s. Now, Colin Ohanian and Amity Schleys, who's written a recent bestseller, which is a kind of popular history of the Great Depression, kind of ascribed this whole thing to Roosevelt. That the claim is it was the New Deal policies that were meant to get us out of the Depression, kept us in it by screwing up the labor market, in particular screwing up the industrial labor market. So that's controversial. I'm saying it's the kind of conclusion that you can start to tentatively make using this kind of model and looking at some kind of supporting evidence. So what do we get out of this? Well, a simple dynamic general equilibrium model that takes productivity as exogenous, and now we know, we want to build a model that takes the financial crises that was occurring between 1929, very end of 1929 and 1933. If we're going to make sense of Friedman and Schwartz and so forth as a model of the downturn, we want it to show up in productivity. But then the model's much less successful, even taking productivity as given, with the 33 to 39 recovery. So at this stage, we don't have a successful model of the Great Depression, but we have at least an agenda for coming up with one. Figure out productivity decline in the first part, figure out what was wrong with the labor market in the second part. So here's the kind of looking at all the chapters we had in this. Now I'm going to talk about Chile and Mexico a bit because Juan Carlos had told me ahead of time that coming to Spain and talking about Spain is kind of arrogant on my part. I should talk about things I know more about. Chile and Mexico I know a lot about. I've been working particularly in the Mexican economy for 30 years. And in Mexico, they invite me to come down and tell them about the Mexican economy. So I'll give you some of my ideas on that. Now, what we found looking at Great Depressions, not the current crisis, Great Depressions, not the current crisis, all of them involve substantial drops in productivity. Some of them, especially the US and German Great Depressions of the 30s, involve something really wrong with the labor market. Massive unemployment that just didn't seem to disappear very quickly. And here's the lesson I'm going to draw, and I'm going to try to be specific on how this applies to the current US and Spanish situation at the end. But my view is that there's shocks occurring all the time. I'm saying exogenous shocks. Some of them, like the housing bubble, could even be endogenous. But I'm thinking bad things happen. In the case of Chile and Mexico in the early 1980s, they were very sharp deteriorations in their terms of trade and very sharp increases in foreign interest rates, in particular the US interest rate. Now I'm going to be thinking about it a little bit later. And that causes something bad to happen. I'm thinking that's what generates things like the business cycle. But to turn that into these 10 years of misery, these gigantic deviations from steady state, something more has to be involved. And I am guessing as a working hypothesis that has to do with government policy. And so the cases that I know in the papers I've written on this actually try to go through and find details of what the government policies are and see if they can work. So here's a picture from Mexico. And my gosh, I'm not hoping that you're going to see much here except whatever happened in around 1980 just whacked that economy out of sync. What's kind of sad is 2008, when I do my calculation of output per working age person, 2008 looked like it was going to be where Mexico just got back to where it was in 1982. And then the end of 2008, things went wrong. Mexico is still not, in terms of output per working age person, back to where it was in 1982. So this is something far worse in terms of loss of output than anything that occurred during the Great Depression in the 1930s.